Well, let's go ahead and get started on that wonderful note. Okay, so tonight's presentation is really about the nuts and bolts of investing. So we're going to go a little bit deeper. As these 8 weeks go, my goal is to provide you some overlapping information that you maybe have heard more than once. So most of it hopefully starts to sink in at a deeper level. You start to connect some dots, and then every week we'll have some new information that you can add to what you're starting to really grasp. Let's get started. So stocks, right? Everybody talks about you should invest in stock. I'm one of them. So the question is, what are the pluses, minuses, and what has the stock market in the U.S., what's it actually done over time? So one, there's your pluses. Again, a lot of times you'll hear people talk about equities. So equities are stocks. There are many pluses when it comes to the stock market, specifically getting a return beyond the inflation rate. It's called a real return on your money. Your nominal return minus the inflation rate is your real return. And that is how we should be evaluating our investments. What do they do after inflation? But they're in minuses, right? And the biggest minus most people think of when it comes to stocks is volatility. Stocks going down during different time periods in the economy. And they do. Recession stocks go down. It can be all kinds of things where 9/11 stocks went down. So that can scare people because they have this perception that maybe stocks will continue to go down and down and down, and it starts to scare them. And then looking at the historical average, so that 10.3% is the historical average, and then after inflation, 7.1%. So 7.1 real return on your money. That's really good. If you can get yourself a 7% return after inflation on average, you're going to be one of the best investors in the world. I promise you. So the key is, how do you get close to capturing that? And then you see about 25% of the time, 27 to be exact, markets went down. Right? So in your mind, you're thinking, okay, out of every 4 years, stock market's probably going to go down. Now, could it go down twice in 4 years? Yeah. Could it go down nothing in 4 years? Yes. But on average, that's your averages. Bonds. Pluses, they provide income, and they can reduce the volatility of a portfolio. So when you have high-quality government corporate bonds, and you have them in your portfolio, when stocks are going down, they tend to go up. So they reduce the big downs in a portfolio. They don't eliminate them, because bonds can go down too, but they can reduce how far a portfolio can go down. And for some people, that helps with the emotions. We don't feel quite as bad because our portfolio isn't dropping as much as it could if we owned a lot more stocks. But there are minuses. So you're generally lucky to get a small increase beyond the inflation rate. Not a big one when you're looking at high quality bonds. So your bonds are not there to give you a lot of growth. They're there to produce income. They're going to pay you interest on those bonds every month, and they're going to reduce some volatility in a portfolio. Historical averages, again, not too bad. But you see here, still, you're looking at a negative return on your money, 15% of the time. The bond market doesn't always go up. It'll go down, just not as far down as, let's say, the stock market. So one way to think about stocks and bonds, stock market is that roller coaster that is just scare the hell out of your roller coaster, right? That's the one that teenagers want to get on and go everything else, and maybe some of you. That kind of scares me, personally. The bond roller coaster is like the little baby ride for the 2-year-old. It's not too scary. It's not going to be real exciting, but it's not too scary. So you can kind of think of them in relation to those kind of rides at the amusement park. Cash. So pluses, right? Feels good. It's not going to go down in value as far as the number, right? In other words, you don't ever look at your cash and it's actually gone down. So that makes people feel better. But the problem is the value of cash will go down over time. It's pretty much a guarantee. In other words, inflation is going to give you a negative return most of the time with your cash. And that's something that we have to remind ourselves. Just because the number doesn't go down, the value of those dollars are less because inflation is eating it up. See some numbers here, but you're basically looking at a zero real return on your money, if not a negative one. It's going to vary per time period, but generally speaking, you should expect your cash to lose to inflation in most circumstances. So if you look at these things over time, you got real estate, many pluses. So here I'm going to talk about commercial real estate, so REITs. Rental properties are going to be very unique based on location, how much you pay, and the rents within that location. But in this case, we're talking about stock in commercial real estate. So the returns are very similar to the U.S. stock market, but rental property can be a nightmare. Who owns rental properties? Yeah. Sometimes they're great, and sometimes, as I'm sure you could tell a story or two, they're not so great, right? Real estate, commercial real estate, tends to be a much easier piece of real estate to own at minimal cost with no headaches, basically. So in this case, REITs have done pretty well over time. You might look at that return and think, wow, that beat the stock market. Yeah, but you're taking more risk, by the way. This falls into small capitalization group, so you're taking more risk as you get a little bit more return. But saying that, certainly worth considering owning. Commercial real estate, doing it right, can certainly be a nice piece of a much bigger portfolio. So that gives you an idea of some of those real returns on your money, right? After inflation. That's generally about what you've averaged over many, many decades, 88 years. So you think to yourself, okay, well, that doesn't guarantee anything for the future. Nothing. I mean, I just went through 10 minutes of telling you what the past is. Well, that doesn't mean that's the future. It gives us a snapshot of what the future might look like, but we don't know that. We don't know just exactly what the returns are going to be per asset class. So that's why we try to own many asset classes, U.S. and international, to try to reduce volatility, try to increase return, and then stay the course over time. In other words, we don't try to time the market, and we don't try to pick which sector of an economy or the world we're supposed to be in, because we don't know that, and nobody else does either. So focus on income-producing assets. Real simple. You want income. So you want dividends, you want interest, and if you own rental properties, you want rent. So that takes you to stocks, bonds, and real estate. It's pretty simple. That's where the investment should be. And of course, when you own assets, when you own these investments, you just want to get those costs as low as you possibly can. In other words, there's a lot of people out there who try to put you in different managed mutual funds and different investments, and they say, oh, don't worry about the price. We're going to get you a good return. You can buy every asset class some financial advisor wants to give you. You can just do it at a much lower cost. So owning multiple asset classes is smart. Diversification is smart. Just make sure you do it at the lowest possible cost. And that takes us to no load index mutual funds. So no load, no commission. You should never, ever, ever pay a load, ever, under any circumstances. So the load simply goes to a salesman that's between you and your investments. And then an index fund, which simply owns an entire market like the S&P 500. So a mutual fund with pooled assets, you own the market and you keep buying the market. You don't try to figure out which stocks to own, you own them all. The good, the bad, the ugly. We don't try to predict the future, we just own those companies. And by the way, let's take the S&P 500. You own that, and there's some companies in there that aren't doing very well. Maybe some of them go bankrupt, can happen. Well, guess what happens? They fall out, and they're replaced with companies that are growing, that are doing something amazing in this new economy. So you get to own the good companies as they come up, and you let go, the market, the index gets rid of the bad companies. So in many ways, it's going to work for you over time. You don't have to worry about discarding bad companies. The market will do it for you. So cost of yearly ownership, stock index funds, you should be paying below that. So US stocks specifically, your expense ratio should be at 0.08 or less. It's a good rule of thumb. Bond index funds, about the same. 0.08, not 0.8, 0.08. That's paying a minimal amount to invest in those asset classes. Real estate, 0.13. It's a little more expensive to manage, so try to keep those fees below 0.13. Again, the Vanguard stock index fund total stock is at 0.04. The Vanguard total bonds at 0.05. The Vanguard real estate index funds at 0.12. And of course, cash, right? Keep what you need in cash, but don't keep too much. Some people like to keep a whole lot of money in cash. Well, it's shrinking, and it's going to continue to shrink because of inflation. So you keep what you need in cash, but try not to keep any more. Get that money working for you, either in stocks or high-quality bonds, based on your own particular situation. Again, another example of what cost does. $200,000 at the start. What's it look like after 30 years? If you're paying 3% a year in fees, you end up with that money. You pay 0.06% a year in fees, 0.07, you end up with that amount of money. And that's the difference. So over 30 years, you could pay somebody $767,000 in fees or not. You could end up with over 1.1 million in your account instead of someone else's. So this whole fee thing is huge. And I will continue to show you these illustrations to hammer this point home. Because at the end of the day, you've got to get it through your head that you have to get those fees down, down, down for your returns to go up, up, up. And will it be easy? No, not always. Because you have a whole industry out there with all its helpers trying to extract as much money from you before it gets to your investments. Your job, my job, is to reduce those fees so you end up with most of the return. And of course, always listen to this guy. And some of you might think, Finley, you've shown me this. Yeah, I'm going to show it to you again. It's not the last time you're going to see this. Again, it's the idea, who are you going to listen to? Your local yokel financial advisor or life insurance agent who makes commissions and loads off the stuff they sell you and educate you on? Or are you going to listen to the greatest investor of our time? He knows the markets. He understands how they work. He knows the industry. He knows how that works. He's providing you the right advice that's best for you. We should listen. Types of risk. So this is a big issue. Sometimes we get caught up in one type of risk. We don't realize there are many. So event risk, right? 9/11 would be a good example. Event risk is a risk that will happen on occasion, and that could very easily hurt your portfolio. We have to be aware of that. In other words, we have this tendency, and that's not just us, Wall Street has it too. They have these wonderful projections. Well, yeah, that's as if everything's going to go just the way it's supposed to go. Well, that's not how life works. Sometimes shit hits the fan. We know this. So we want to be careful of thinking we know the future because we don't. And that's why we want to build a portfolio that's built for an unknown future. Interest rate risk. So I think this is a good year to explain this, right? So if you'd have spoken to many people latter part of last year, they say, oh man, rates are going up, up, up. Man, they're going to, well, guess what? They haven't. Now they're going down. They're either staying put. The Fed came out today saying, well, I think we're going to keep rates low. We're not going to probably raise them the rest of the year. Well, that was very new to what people were thinking at the end of last year. So interest rates have a big impact on markets. As a matter of fact, I would tell you it's one of the biggest factors on market returns, on your bond markets and on your stock markets. They like low interest rates for many reasons, and they do not like interest rates going up for many reasons. Liquidity. You want to make sure you can get money out if you need it. So there's a whole industry out there that sells private equity and limited partnerships and private REITs, crap that locks up your money for a long time and you can't get it out. I mean, you literally cannot get it out. You say, I want it. Well, yeah, we'll tell you when you can get it. Screw that. If anybody is telling you that they're going to dictate when you get your money, you need to run away from them. Do not allow people to lock up your money in illiquid assets. You will pay a lot in fees, and you will be disappointed at the end of the day for many of those returns. And tax risk, right? So how the tax code is created, how it's changed, that has a real difference in a portfolio. How it's taxed from a capital gain piece versus a marginal tax bracket. Tax risk is a real risk that we should all be thinking about as we put together a portfolio. Same with political risk. Do I need to say any different here, right? So, and by the way, this is not a political statement. Well, Donald Trump, yes, there's political risk. Well, there's political risk with Barack Obama. There's political risk with George Bush and Bill. In other words, there's political risk when it comes to politicians, and that includes a Congress. And so you might think, well, this guy's an idiot, or this guy's great, or this. You can have an opinion on any political figure you want. At the end of the day, there's a risk that comes with politics because they make big decisions that can affect wide swaths of the United States. By the way, I know this isn't really there to make you feel warm and fuzzy, right? Because I'm going to keep lining up these risks. I want you to realize that. And I want you to realize, oh, shit, there's all kinds of risks. And for some people, that causes more fear. What I would want you to be thinking about is, okay, that's why I diversify. That's why I do a lot of things, because there's a lot of risk out there, not just one, such as market risk. Currency risk, right? The currency of international trading. That can be a real risk in itself when the dollar is being transferred over one way or the other to different countries. Opportunity cost. So that's a risk where money here isn't there. So putting money toward debt, putting money toward gold, or some other kind of thing is money that didn't go, let's say, to the stock market. So opportunity risk is something we also should be thinking about with every decision we make. The reason why those three are highlighted in red, you can get rid of them. See, the previous ones, you're not going to get rid of them. They're there. You mitigate them. You try to do what you can. Business risk. So owning an individual stock, that's business risk. You don't need to do that. You shouldn't take that kind of risk. So you can get rid of that. You do not need to take on that risk. Manager risk. You don't need to take that on either. So a managed mutual fund, which we know historically does very poorly to simply owning the market and owning an index fund, you can get rid of that risk. You don't need to own managers. You don't need the risk of managers doing a poor job. So you can get rid of those two risks just by eliminating individual stocks and managed mutual funds. Finally, default risk. So this is owning high yield bonds. Sounds good, doesn't it? I'm sure some of you know. What's a high yield bond? Junk bonds, junk. Well, that didn't sound so good. So junk bonds, basically, they'll default on occasion. So people invest in high yield bonds thinking they pay more yield. Well, it's because some of those companies will not pay. They will go default. So don't play that game. Don't chase yield without realizing there's a lot more risk in those kinds of bond funds. So you can get rid of default risk by not owning junk bonds. So those three types of risk you can eliminate. And when possible, you want to eliminate as much risk from your portfolio as you can. You can't get rid of all of it, but you can get rid of some. Market risk. So if you're going to be in the stock market, you can't get rid of that. Stock markets go up and down. Going long, going short. Sometimes people will hear that. What does that mean? Well, going long is simply owning stocks. In other words, you're investing long term. So you may be willing to take short-term risk to get long-term gain. Stocks have done that historically very, very well. Going short, well, a lot of hedge fund managers, they play all kinds of games with a whole lot of costs and taxes to try to reduce any loss in the short term. You don't have to play that game. All you have to do is own high-quality, short, intermediate-term bonds. That's your short game. So the long game is stocks. But in the short term, when stocks are going down, high-quality bonds are going up. That is your short game. Over time, they work together to give you a decent return on your money. The long game and the short game can be played by people like us at a very, very low cost and very tax efficiently. And then inflation. And of course, yes, I highlighted it bigger than the rest, because I would tell you that's the number one risk. That is it. You should look at that as the big monster in the room. Those other things are there. You factor them in, you mitigate them where you can, but boy, don't lose track of inflation risk, and a lot of people do. You know, the person who keeps an extra $50,000 in the bank isn't paying attention to inflation risk. That money is shrinking right before their eyes. So understand that monster and find ways to beat it. Yes, sir.
The national debt becoming a more current risk?
Can be. I would almost put that under political risk, personally, right? Politicians get to decide how much revenue tends to come in and go out. And so, yeah, I mean, I would agree. That would fall under political risk in my mind. Yep. Some terminology, right? Getting these terms down will make more sense, especially as these weeks go on. Understanding the language can help you better understand how to play this game well. Securities, people talk about securities. We're simply talking about owning stocks, owning bonds. That's a security. A mutual fund, just pooled assets, right? A lot of money put together. You could have the Vanguard Total Stock Market Index Fund and have billions of dollars in there. Because of that amount, you can invest at a very low cost, thanks to John Bogle and how he built Vanguard. Managed mutual fund, it's managed by humans, right? People managing funds. And it, right, to the brain, it's like, well, of course. No, you don't want that, because they do a poor job in reaching the market return, and then they cost a lot more. So they have a hard time beating the market, and then the cost factors in, so they lose to the market more times than not. And of course, that index fund, there aren't really humans involved. It's maybe one guy who's managing, just make sure they have everything, and they just do it at a very low cost because there's not a lot of buying and selling. There's not a lot of people getting paid and analyzing. None of that. It's just pushed aside to get to you at a low cost. Saying that, right, not every index mutual fund is the same. There are high-cost index mutual funds. There are index funds out there you pay a load to own, which is absolutely insane, right? You want low-cost index mutual funds, which, again, is generally below 0.10. More terminology, asset class. So an asset class, owning stocks, bonds, cash, real estate, that's an asset class. Categories, right? Well, maybe you have United States stocks, United States bonds, or international stocks and or bonds. And then a style. You hear terms like growth and value, small companies, and quality versus high yield, i.e. junk. In other words, you break it down, which we'll go in more detail in the coming weeks. And then asset allocation. We talked about this a little bit. how much are you going to own in stocks versus bonds and cash and maybe some real estate? What is your asset allocation and what do you want it to be going forward? Recency bias, right? Whatever just happened has an effect on us. We think it's going to keep happening. It's a very emotional thing that is very normal. So by acknowledging that, we say, okay, I can react in a negative or positive way. Market's going straight up. I think I got to get in before I lose. No, you don't. It's going down. Got to get out. No, you don't. You just got to stay the course. You got to keep your emotions when others are losing theirs. The efficient market hypothesis, that idea that the market knows more than you and I, and it does. It knows more than any human being out there because it's full of millions of trades, all kinds of data from all over the world. As soon as the market connects with it, boom, markets are changing in moments based on that information. So you and I don't have to acknowledge that we know what's coming. We just simply have to own that market and let it do its thing. Now, sometimes it could be wrong, but it still is acting on all new information so much faster than individuals like you and me. And that would include some managed mutual fund as well. Negative correlation, seesaw effect. You want asset classes in your portfolio when something's going down, the other's going up. So a really good negative negative correlation is the total stock market index fund, all U.S. stocks, versus the total bond market index fund at Vanguard, all high quality bonds. So they tend to go in different directions. Not always. Every day that can change, but over time they tend to be negative correlated. That reduces volatility within this big portfolio. And then variance, two big words, geometric versus arithmetic. Here's what I would say to you. When markets go down, you have to make a lot more money to recoup that geometric average, the mean. So you're looking to try to reduce some of your volatility because you don't want something that goes down 60% because you got to make a lot more than 60% to get back to where you were. So you want to reduce the downs, can't eliminate them, but reduce them as you can get back up to where you were and then beyond. So geometric mean is averaging those returns and then what you have to earn to get back to where you were. Arithmetic mean is not really what you want. So if you go to, say, Vanguard, you'll see the geometric mean. It'll show you the averages, losing this, gaining this, losing this, gaining this. Reversion to the mean, what goes up will come down. It's very, very important. It goes with recency bias. We think, oh, that's going to keep going up. No, things go back. They fall. Oh, it's going to keep, no, it's not going to keep going down. It's going to go back up. It's going to revert back to its historical average, right? We talked about the U.S. market averaging 10.3. It will come back to that or down to that as time goes on. Loss aversion, we as individuals, oh my God, we can't take losing money as well as we can making money. It feels worse to see the value of our portfolio go down by $20,000 than to see it go up by $20,000. There's something in the human psyche that says, I don't like that. Well, it's okay, I don't like it either. But that's a natural reflection of how markets work. If you want a decent return on your money, you have to be willing to put up with the negative time periods. You have to be willing to take risk. No risk, no return. It really is that simple. You just want to make sure you take the right amount of risk, mitigate it as best you can, and then keep feeding that portfolio over time. That real return I talked about, right? Nominal return, right? So let's take a bank account. Let's say the bank's paying you 0.5%, 0.5%. And inflation's running at 3%. Well, your real return is minus 2.5%. The value of your money is going down by 2.5% a year because you're only earning 0.5 and the inflation rate is 3%, let's say at that time. You want to earn a positive, real return on your money. If you're not doing that, your money is shrinking. Modern portfolio theory, it's simply this idea that we pull all this stuff together into this mix to make for just the right portfolio. It's called a stew. The asset allocation stew. You pull some stuff in, right? Jalapenos, meats, potatoes, all kinds of stuff that can make it a really good stew rather than just throwing a jalapeno in there and serving it. It's not going to be good. A jalapeno could be emerging markets, owning China, Brazil, Russia. You might think, oh my God. Well, yeah, but you pull them all in together, and when something's going down, something else is going up. So you put together this stew, which is your portfolio. You own different asset classes that makes it just right. Now, doesn't mean it's always going to be great. Sometimes you can have the best stew in the world, the best portfolio, and it can still go down. But it will go down less because you put it together with those negative correlations where something's going to be doing better as others are doing worse. And you don't try to guess which one's going to be doing better because you and I, we don't know. And nobody else out there does either. By the way, I'm happy to send this PowerPoint to anyone. If you send me an email tomorrow, I'll send this to you and you review it at your own leisure. Parentheses, those are the fees. That's the expense ratio for those funds when this was created. So now real estate is down to 0.12, emerging markets down to 0.14, total bonds down to 0.05, small caps down to 0.07, 0.07, and 0.04. Now, how'd they go down? It's the way John Bogle built Vanguard. Those were all Vanguard index funds. He built it in 1975 for the investor, us. So when more money comes in, instead of bonuses getting bigger for the employees and big shots, the fees of the investments come down. And so over time, not just millions, not just billions, but trillions of dollars have come into Vanguard, has over $5 trillion under management. And because of the way Bogle built the structure of the company, you and I pay less in fees. So in 1, 2, 3 years, you're probably going to pay less today then. And again, that benefits you and me. The industry, not so much. But what Bogle tried to do, and he did, he put us ahead of the industry. And by doing that, he changed the world. So mistakes, we got to know the mistakes and avoid them. Life insurance products, one of the very worst ways to invest your money. We're talking whole life, talking annuities. Now, why is that? Well, it's real simple. They're laden with fees. I mean, they have a lot of fees. And those fees end up getting paid by you. But they're baked in. So it's not like you get a bill, because they've learned. People don't like getting a bill. So they don't give you a bill. You pay it as you own the product. Load managed mutual funds, right? Paying a Class A, Class B, Class C load that simply goes to a salesman. It just reduces your return over time. That's it. Does nothing to help your return. It hurts your return because there's a commission coming out to pay some salesman who pulls your money in. Alternate investments like gold and silver, historically they've been very poor asset classes. They barely stood up with inflation or less, and they produce no income. The only way you make money on those kinds of commodities is some sucker pays more in the future than you paid. Is that possible? Yes. Is it probable? No. And individual stocks. High risk, low return. Now, can somebody buy an individual stock and do really well with it? Sure you can. You can go down to the casino and hit jackpot. It's not probable. It's possible. You want to play the probabilities because this is your career. This is your portfolio. This is your future retirement money. You want to be as smart and efficient with it as you possibly can. You don't want to play games with it. And you're playing games when you're buying individual stocks. You are. That's much closer to gambling than owning an index fund that owns thousands and thousands of individual stocks.
Someone has a life insurance policy and they've been paying into it, say, for 40 years. There's a cash out value on it. Would a person be better off cashing that out and putting it in?
So the general answer is yes, but you have to look at each individual situation. Do you need the life insurance, right? So a lot of times people may buy the life insurance when they had kids in the home, and all of a sudden the kids are gone, you're 40 years old, and you're thinking, why do I still own this? And that cash value is something that can be used for your portfolio. You pull it out. One, you save on the yearly premiums, so you stop paying premiums. And for some people, oh, it's paid up. Well, that means the dividends are paying the policy. You don't want that. It's going to eat itself, basically. And your insurance agent is going to make a lot of money off that cash value policy, especially in the first year. So don't expect them to think it's a good idea to cash it out. But it would serve your needs to cash it out in many cases, put it in your portfolio, get it working for you, because it's not going to do it in an insurance policy. ETFs up there, stay with me on this one. So exchange traded funds. If you own the right ones, there's nothing wrong with them. You could own the total stock market index ETF at Vanguard, just as low cost as the index fund. Great. I don't recommend you do it, because here's what we know, and this is John Bogle's advice too. There is how it can be used versus how people use it. People treat ETFs more like individual stocks. They trade them a lot, because you can trade an ETF in real time. You can go on and sell it right now because now's the perfect time, you think, or buy it right now. Well, you end up trading them like individual stocks, and they perform badly because you're treating them like individual stocks. If you treat an ETF, a total market ETF, like you would an index fund where you hold it for years and maybe decades, then it would be just fine. But we know people don't do that on average. So I'm not a fan of ETFs because of how people actually use them, not because of the ETF itself. Now, Wall Street loves them because people trade them all the time, and there's a lot of transactional costs, and Wall Street makes a lot of money on those transactional costs. More mistakes. Time in the market. It's a very, very, very bad idea. You got to be right twice. You got to know when to get out. You got to know when to get in. And you don't know. Neither do I. Neither does other people out there. There are people who will send a newsletter. They'll have you pay for a newsletter, and they're going to tell you when. Don't do that. You're wasting your money. That guy should be tossed aside. Timing the market is a terrible mistake. And that's one reason why many investors that have done so poorly in the stock market, because they get in, they try to time it when everything's going well, and then they get out when the markets collapse, and then they wait so long to get back because they're not sure when to get back in, and they're sitting on the sidelines, and the market has been going up ever since. Get in the market, get the right allocations, and stay in the market. We know historically that is the way you're going to make money in markets. Owning the right stuff. So anybody can do this. You can go back over the last year, let's say, and you would see that owning a certain segment of the U.S. economy would have been awesome. Maybe technology stocks. Maybe they went up 45%. And you think, oh, I should have. Well, we can all do that. We can all look back in time and say, I should have owned that. But nobody knows what you should have owned over that time period. We only know when we look back. So do not listen to people who data mine. They take data from certain time periods, and then they tell you why you should own it here, 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 because they've used that data to try to convince you they know something about the future. They do not. Don't live in the past. Focus on the present and accept the reality that we have an unknown future. Trading often is a big mistake. We want to avoid that. So you buy mutual funds, index funds, and you buy them again, and you buy them, and you don't do anything. As John Bogle said, the best holding period is forever. right? And it's the idea, the mindset that I'm not into selling and buying. No, I'm just going to contribute over a long period of time and put trust in markets that they will do well. And they have. They've done very well for the average investor who knows how to play this game well. And then going with a hunch, right? Terrible idea. Terrible, right? The ego. The ego that says, I know something that others don't. No, you don't. No, you don't. You don't. So let that go. And don't listen to people who tell you they know, because they don't. Ego can get us in big trouble when it comes to investing our money. Chasing performance. This is a tough one. A lot of people fall for this. And I fell for this early on in my investment career. So let's see now. What funds do I want to own? Well, I want to own the 5-star funds from 1 to 5, 5 being the best. That makes sense, doesn't it? I want to own the best. Well, they were the best in the past. So you're buying the past winners with an unknown future. And it's very possible that reversion to the mean could happen. The 5-star fund can turn into a 2-star fund. So chasing performance, chasing stars is one of the worst ways to do this investment game. Do not chase stars. Ignore the stars. How a fund did over the past 1, 3, 5, 10, 20-year time, it's irrelevant. Don't give it any thought. Focus on your allocations to what you want to own and get those costs down as far as you can. Chasing yield, it's a mistake. Chasing yield. I want high yield stocks, let's say. I want something that's paying 3% a year. There's a reason why it's paying 3%. It could be a sickly company or a mutual fund that has a lot of sickly companies. Don't chase yield. It's a mistake, and we know this from a lot of research. Don't let those emotions come up, whether it's your fear, your greed, overconfidence, even Mensa. So some of you might know, Mensa is like this really high IQ group, and they had this investment club. And they put it, you know, they do all their investments, they're so smart, and after 2 decades, they ran their numbers, and they lost terribly to the S&P 500. I mean, really bad. And they asked one of the members, like, what do you guys do? He said, I don't know. We seem to buy low and sell lower. And these are smart people. I mean, it's not an exaggeration. This has nothing to do with IQ. Nothing. This has to do with knowledge. So rest assured of that. It's a matter of knowledge that will help you to become a very good investor. Not because you have a certain IQ that goes with you as an individual. As a matter of fact, you might be very careful about high IQ people who think they know something that is going to make the money. They don't. And then the media. So it's always a good time to watch some video. So listening to the media is a fool's errand. We should ignore the media. Now, if you want to watch the media for entertainment purposes and laugh at them, okay. But do not listen to them for advice, for reasons on what to buy and what to sell. And sometimes a video can tell the picture. So first of all, some people think this is what investing looks like. Okay, that's all I can handle. Now let's watch another video of Jim Cramer.
Although Jim Cramer did write an article for MainStreet.com complaining that we had unfairly used the video footage out of context, made it look like he recommended buying Bear Stearns stock a week before it collapsed. Okay, I was wrong. Actually, it's true. He wasn't saying to buy Bear Stearns. He was simply saying that if Bear was your broker, that your money was at Bear, your money would not disappear. He's not addressing the value of holding Bear stock. So, Jim Cramer, I apologize. That was out of context. Technically, you're correct. You weren't suggesting to buy Bear Stearns. That was something that you did 5 days earlier in your buy or sell segment. I believe in the Bear franchise. You know, at 69 bucks, I'm not giving up on the team. Yeah. First, well, Cramer wasn't giving up on Bear at 69. 11 days later, the stock market was more comfortable with it at 2. You know, I'm reiterating, I like Bear at 60s, I like Bear at 70s. He's not saying literally, I'm asking you to buy Bear Stearns. For that, you'd have to go back a full 7 weeks before the stock completely collapsed.
I'm asking people who are watching this video to buy Bear Stearns.
Now it's 7 weeks before it collapsed. In the interest of context, continue.
I'm asking people who are watching this video to buy Bear Stearns. Now, Bear Stearns acts much better than it should. Now, that's just intuition. And I don't want to put too much faith in intuition, but I have had good intuition over years of investing. And I just think that this one has a very big upside, very limited downside here. It is, I think that last quarter, they just launched the losses. They're very good at cutting the losses at Bear. But Bear, I'll move this for sale and for many buyers.
Could be a bit more.
Yes.
All right, Jim Cramer, you said it there. Bye there.
So he's a clown. There are many clowns on television. The person we should be listening to, John Bogle, founder of Vanguard.
The first step to say, okay? Step number 2 is how do you want to say, well, it's risking anything you want to do. You say in dollars or rands, as the case may be, over time they are badly eroded by inflation. So they're secure, government bonds are secure, cash is secure, but they have a much lower value. You retire a whole issue down the road. You have to think of something that will give you enough for a better return. And that better return, as far as I'm concerned, comes from owning businesses. Owning businesses that make money, that have earnings, they do that. In the long run, the way to collect wealth. Part owner of a business, when you own a share of stock, it's not very complicated. So, how do you pick which businesses to own? The answer to that is you don't. You own all businesses. You own every business in your country or every business that you like in the world. And then the key to doing it is owning it at low cost. Business generates returns, dividend yields, earnings growth. So you will make money as long as business makes money over the long run. But you want to get your share back. And the way to do that, get your share, to acquire those businesses at a nominal cost. You don't pay very much for it. Because you pay, if business produces, let's say, an 8% return, and you pay 2%, that's 25% of your return. So get the 8. Don't get the 6. Because in the long run, as we all know, the miracle of compounding returns gets overwhelmed by the tyranny of compounding costs. You will put up 100% of the capital. You will take 100% of the risk. And yet, financial market system that charges you for 0.5% on average, puts up 0% of the capital. Take 0% of the risk. You get gets about 75% of the return. Not a good way to own all those businesses. Three stages. First, everybody says it will never work. Stage 2 is, yeah, it works, but it's just luck. And stage 3 is, of course it works. That's why I told you in the first place. And we've gone through all that. And so now you can, it's really amazing to me, cannot open a newspaper. It's yesterday's New York table without seeing a great big bug for Vanguard that doesn't even mention our name. Word the world is coming around this idea of owning market, owning business, of getting costs out of the system, of sensible asset allocation, protect you from perils of your own misbehavior or behavior, case may be. And so, of course, it feels good to become the largest company in the world. I don't think about that. But for whatever that says, it must have struck a resonant chord somewhere in here. Because we're now probably talking about 66% of all money that's voted in the U.S. mutual funds in Vanguard. 2/3 of the funds. So I understand not. That's not going to put it. Wake up, competitors. You got to know about it.
Knowing who to gather our education from is key. Why I'll be bringing in books every week. Gathering the right information from the right people will set you down the right path. It is that simple. And that guy is not it. So consider Vanguard, right? Pay no loads. There's no Vanguard commission salesmen out there. They don't exist. Pay very low fees to own index funds. You'll have many options. So you have a selection of index funds to diversify you all over the world. And you can transfer funds there. So if you have a Roth IRA or an old 401k that is sitting out there in high cost managed funds or some kind of crappy annuity or whatever, you can transfer those assets over to Vanguard and then own index funds. How many people have done that in this room? Yeah, quite a few. So it's doable. Is it a little challenging at times? Sure. Why is that? Because these companies start to feel like it's their money. And you're pulling it and they're saying, no. Because, of course, they're making a lot of money off you. So if you want to make money off you, get control of it, stick it in low-cost index funds, and over time, that small difference becomes a very big difference. It's a list of Vanguard stock index funds that I would recommend. They're all very good funds. So that total stock market index at the beginning, the very top, that owns the entire U.S. economy. The cost of 0.04. It's awesome. That would be a core holding. That's where you'd want to own most of your stock, at least say half of it. Total International Stock Index Fund. So that owns pretty much all the stock outside the United States. Developed countries like Canada and Austria and Germany, and emerging countries like China, Taiwan, India, Brazil, all in that one fund. So those two funds at the very top, you could own all the stocks in the world at very low cost in those two funds. Real estate. So stock in commercial real estate, you can own that. It's U.S. stock. 0.12 is the cost, nice and cheap. Emerging market stock. So if you wanted to break up your international to own developed and emerging separately, you could do that in those index funds. And owning small cap value. I'm going to briefly talk about it tonight. We'll talk about it more in the future. What we know from past research is by overweighting, having more small cap value than you have within the portfolio, because this is contained within the total stock, owning more of it has produced a higher return on your money. How much? Well, this fund has averaged about 15% a year, while the U.S. stock market's average 10. So will that continue in the future? We don't know that. But there's some real behavioral finance issues that tell me it probably will. So what does that mean? Well, small cap growth tends to be overly traded and underperforming. So small growth, what does that mean? That means the hot companies, companies that have IPOs like Lyft and Facebook and stuff that just comes out and people get all excited about, Tesla, and they get overly traded and they underperform historically over time at higher risk. While small cap value, that tends to be companies that people don't trade as much because they don't really like them as much. They're not very sexy. So they don't talk about them on television. So at the end of the day, it's like, yeah. And yet, because of all of that activity, they tend to overperform. Again, does that mean that's exactly what's going to happen in the future? No, we don't know that. But that's what's happened in the past. And as long as there's human beings involved, I'm betting that's going to continue. So overweighting, having a little bit of that extra in your portfolio is certainly worth an option. I do it, but that doesn't mean you have to do it. But it's something to consider as you gather more education on this topic. Questions on any of those stock funds? So Vanguard bond and money market. So those first two bond funds at the top, those are great funds to own if you want to own a bond index fund. So first one's a short-term maturity, so it's a very low-risk bond fund. And then the second one is intermediate-term maturities. A little higher risk, a little higher yield. So owning one of those in a portfolio can reduce volatility. All high-quality government and corporate bonds. Could you own both? You could. But owning at least one of them will help with the volatility of a portfolio. Total International Bond Index, you could use that. So international bonds outside the U.S. I'd be a little careful. You know, I've waffled over time on whether or not to own them myself. I personally don't. It's the biggest asset class in the world, so you could certainly make a case for owning it. But here's what I would throw out at you. High quality bonds in China, I'm not sure they're the same version as high quality bonds in the US. Some of you might agree with me, maybe not. So I'm a little reticent of owning high quality Russian bonds and Brazil bonds. They may say they're high quality, meaning they're going to pay out. I tend to think we're taking more risk than I really want to take. So personally, I own only high quality US bonds. But there's nothing wrong with owning international bonds. But be aware that the ratings on bonds, they're a little bit dicey even in the United States. And if they're a little dicey here, I think you can imagine how dicey they can be outside our borders. Intermediate term tax exempt funds. So that's a fund to own outside of retirement if you're a high income person or couple. So if you're in the tax bracket, marginal tax bracket, 22% or more, you might consider holding bonds outside of there if you want to own bonds, because that fund will pay no federal income tax on your yield, on your interest paid. You'll pay state in the state of Iowa, but no federal. And that works if you're in a higher income bracket. If you're lower income bracket, you don't want to be buying that because it's not, because you're going to get a little bit less, and that only benefits you if you make a lot more money. And finally, inflation protected securities fund. Basically, it's a bond fund that you should hold only in retirement accounts, but it gives you an inflation protected return. If inflation goes up, it'll boost the yield to capture that. Saying that, it's not that risky, so you shouldn't expect a great return from it. But you might be able to stay up with inflation. And then the prime money market, it's a place to keep cash. Right? If you look at where can I keep cash where it's earning something and I can get to it whenever I want it, the prime money market's a pretty good place. So compounded right now, it's earning 2.48%. Keep your cash there. You can go online, you can call Vanguard and get that cash back to your checking account in 2 business days. So it's liquid, you can go get it, but it's actually earning something. So that is a list of funds that you would consider. You really don't need any more funds than that. Could you add more? I suppose you could. I don't think it's necessary. So Vanguard has, you know, maybe a couple hundred mutual funds. Okay. You need 4, 5, 6. That'll do just fine. And when I say Vanguard, you could identify these funds within your 401k in a very similar way, or 403b. Yes, sir. Yep. So total bond, the second one's 0.05, great cost. I think the short-term bond index fund's 0.07, I believe. So their expense ratios are very good, very good. Yep. Total bond, maybe 5%. Short-term bond, maybe 3%, right? So again, they're not going to give you great returns. That's not their purpose. Their purpose is to produce monthly interest and to reduce the volatility of a portfolio. So you would increase the allocation to those kind of bonds as you start to maybe get older and you want less volatility in your portfolio. Maybe you're leading into retirement or you're in retirement. You start to reduce some of your stock exposure and end up buying more bonds within, say, retirement accounts. Yeah, $1 million question. So first of all, you don't, and don't let anybody tell you, oh, there is no perfect allocation. You got to figure out your situation, and there are a lot of variables. Over the next couple of weeks, I'll be talking specifically on asset allocation. And at the end of the day, you have to decide that. I'll give you numbers. I'll show you how to put things together based on the percentages you want. I'll show you what I do. I'll show you how I put together a portfolio. At the end of the day, you got to figure that out yourself. You own the right asset classes, and then you simply choose the percentages that you want to own. But it's an imperfect science. Now, by the way, we look back in time, it's easy. I should have owned that. Well, yeah, but that's going back in time. Going in the future, you try to figure out how much of a return am I trying to get, how much risk am I willing to take, and how can I do this at the lowest possible cost? Wishy-washy answer, but it's the best I can give right now. A couple of weeks, they'll be more in depth.
What's the cost for changing? Say you decide you want more bond funds this year, but next year you want more stock funds. Does it cost to change one index fund to another?
Not within a retirement account. So let's say Vanguard, no cost whatsoever and no tax consequences. So when you are rebalancing, you're owning, say you're going to buy more bonds and less stocks, do it inside a retirement account. There's no cost to do it, and there's no tax consequences. If you buy and sell outside of retirement accounts, let's say in a normal brokerage, you're going to be paying capital gains. So that's generally not the place to be switching if you need to rebalance, which we'll talk about in more depth. But you should be concerned about those things. If I have to rebalance, are they going to nickel and dime me? So Vanguard's not. They're not going to nickel and dime you with small fees along the way. We talked about these expense ratios. That's it. You pay 0.05 for the total bond. That's all you're going to pay. Not more, not less. That's the yearly expense. Yes, ma'am. You bet.
Well, now, where would I start with that? Like, if I don't have enough money outside of my retirement accounts to start to buy everything up there all at once,
Right.
what would you recommend?
And that's a very good point. And we will cover this in future classes. But you look at what you own in your 401k or 403b, right? And then I would always start with the Roth IRA. It's a retirement account, but you can access those contributions anytime you want, at any age, with no penalty and no taxes. Just the earnings have to be pulled out after 59 and a half. So a Roth IRA can be used in many ways. Otherwise, a brokerage account at Vanguard is non-retirement. You could start a brokerage account, let's say they have a settlement fund, some federal money market, for whatever, $10. So you can get that started. And I would encourage you to consider having 3 buckets: a pre-tax retirement bucket, an after-tax Roth bucket, and a non-retirement brokerage bucket. That's going to give you more flexibility as time goes on, because they're going to be taxed differently. And you want flexibility as it relates to taxes in your future. And those are things we're going to be talking about more in the coming weeks. You have a question, sir?
IRA account, that's running. One over Vanguard. It's
No, you didn't. The whole 50. You can move an IRA to an IRA. You can move a Roth IRA to a Roth IRA. Your cost basis will come over with it. So there's paperwork that comes with it showing how much money you put in over time. A retirement account is an individual account that will always stay in your name. You can identify a beneficiary for that retirement account. If you have an account outside of retirement, a normal brokerage, you could make that a joint account if you choose. But otherwise, retirement accounts are individual accounts. Yeah. So the answer is maybe. So, generally speaking, the answer is no, but if you hit a certain age, many plans provide the opportunity to move money out based off your age. So 59 and a half is one age. Some may say if you're over 59 and a half, you can move your money out, say to an IRA. Some may say 62. Some may have 65. Some may have 70, which I'm personally not a big fan of. I think you should be able to move money out at 59 and a half. That's a retirement age number that we use in society. But nonetheless, their plan document will state what can be transferred out. It's a distribution, but you would distribute it to an IRA at another institution. You wouldn't actually pull it out and pay tax on it, right? Yes, sir.
Distributions on IRAs in case of death to a beneficiary if those are simpler than we think, right?
Well, it can be. So it's simple if it goes to a spouse. So husband passes away, his IRA can become the wife's IRA, and it's all done, right? But if that IRA goes to, say, a son or a daughter, then it's deemed an inherited IRA, and then they have to take what's called an RMD on it, required minimum distribution, and they have to decide, are they going to take it out over a lifetime, they're going to take it out over 5 years, or are they going to pay tax all the way up front? So it's more complicated when you inherit an IRA and you're not the spouse. And we'll talk about that a little bit more as time goes on as well. Good question. Good question. Okay, so others, right? I've been talking about Vanguard. Schwab has many, many good low-cost index funds. There's nothing wrong with Schwab. Fidelity, nothing wrong with Fidelity. They have many good low-cost index funds. Just be careful of Fidelity. So what's happened, again, Bogle started Vanguard in 1975, and everybody laughed at him, said, oh, people are going to want those index funds. Well, pretty soon, over time, people wanted index funds. And Vanguard started getting so much money, and it was leaving these institutions. And they said, oh, shit. And so they started offering low-cost index funds to compete with Vanguard. Well, Fidelity went down to zero-cost index funds. They actually have index funds with zero expense. And you think, what's that? Well, they have 4, and what you want to be aware of is there's nothing wrong with them. It's the truth, but it's a bait and switch. So they want you to come in to buy those index funds, and then they're going to promote their managed funds that beat the index. Of course, it's deceptive. They're going to tell you about the 20, 25% that beat the index. They're not going to tell you about the 75 or 80% that didn't. And they're also going to try to sell you their advisory services, which are going to cost a lot more money. So you want to be careful of that. It's something Vanguard's not going to do to you. But saying that, there's nothing wrong with Schwab and there's nothing wrong with Fidelity. If you like their platforms and you like their website and you want to invest in their low-cost index funds, have at it. There is nothing wrong with them. Retirement plan, right? So you look inside your retirement plan, what index funds do you have there? Look carefully. And if you have none, it's time to start hollering. Why don't we have low-cost funds within our retirement plan? You should. And you can, with others, make a difference by getting them in there. You can trade at TD Ameritrade. These are places you can use. And, you know, in some ways, you can invest in low-cost index funds, but I would tell you they're dangerous. Dangerous. It's easy to start going down that path of trading individual stocks, ETFs, because, you know, that's how they make their money. So be careful when you start getting on these platforms where it's all about trading. Trading means less money for you. Some resources, right? A couple of my books up here, as well as those 3 books there. They'll guide you down a really good path. What I try to do with What Colors the Sky, it's a book on investing, try to take those couple hundred investment books that I've read and put them together in a book that you can understand. So find out what book or books that are going to help you with the right authors, and you can speed up the process of learning about this information dramatically. So that's what I wish somebody would have done for me, because guess what I did? I read a lot of the wrong books because I didn't know. I didn't have some old white guy saying, hey, Finley, you should do this. Didn't have that. So what I'm trying to do for you is saying, whoosh, there you go. Go down that path. Don't mess with this and this. Just go there, because those people will guide you. They'll guide you well. And those authors will, I promise. Okay, questions? Questions on anything we covered tonight? And by the way, right, we're adding to what we learn every week. So there'll be plenty more information on asset allocation in the weeks coming. We'll be talking about the crooks and how to identify them. We'll be talking about financial advisors and how to understand the difference between a fee-based and fee-only advisor. We'll be talking about emotions, and we'll be talking about just the plan going forward. Yes, sir. Say that again. I think I've heard of it. Tell me about it. I don't know. Yeah. Okay. Yep. Yep. So I don't know. I don't know. I don't have any negative. That's always good news, because I generally have a pretty good negative opinion of because, right, the industry is built for the industry. You've probably heard me say this, and I'll say it again. It's not built for us. It's our job to figure out how can I maneuver around most of the industry and all that costs so I end up with the returns. Other, yes, sir. Yep. So Admiral shares used to be at Vanguard. You got the lowest cost index prices with Admiral shares. It used to be $100,000. And then again, based on how Bogle built this company, that price came down. So now you only need $10,000 to get Admiral cost. Well, they came down again, and now you only need $3,000. So you need $3,000 to start an index fund where the cost is 0.04 for the total stock market index fund. That cost, usually in the past, you didn't get that till you had $10,000, or years past, $100,000. Again, the way Vanguard was built, more money comes in, that cost continues to come down. So you want to own Admiral shares, and basically you'll get them in index funds at $3,000. Managed funds at Vanguard, you get Admiral shares, I believe it's still at $50,000. Of course, I don't pay too close of attention to that because I wouldn't own managed funds, whether they're at Vanguard or anywhere else. I play probabilities over possibilities, and so should you. Other questions? Yes, sir. About 2%. So when I say don't chase dividends, don't chase companies that produce 3.5%, 4.5% dividends. That's generally a sick company in today's economy. So the total stock market index fund owns about 3,700 stocks, businesses. Every single one of those stocks tend to have some kind of dividend payment. Well, combined, you're going to earn about 1.9% dividend from the total stock market index fund. And that's going to be paid out every quarter. Right? And every mutual fund is going to have a dividend it's going to pay. It's just going to vary on what it owns inside that mutual fund.
What about the stock companies that have recently raised their dividend over the last 25 or 30 or 40 years?
Yeah. And that's okay. It's okay. I don't mind owning them. I'm just going to own them inside a mutual fund. I'm going to reduce the risk of those companies because let's take a look at AT&T. Anybody own AT&T? Well, if you own the total stock market index fund, you own them. Well, they pay out like a 4.5% yield. So you think, oh, that's pretty, no, it's not very good because they suck. That company has done very, very poorly. So it's the total return we're focused on, not just the dividends. So you heard Bogle talk about the dividends plus earnings growth of the company gives you your return. Well, you get 4.5% dividends from, say, AT&T, but their earnings growth is like -1. So your total return is like 3.5%. So that's why we want to be very careful about chasing dividend growth, chasing yield. Any other questions? Yes, ma'am.
Did you say you use TurboTax to do your taxes, or?
I used Credit Karma this year.
That's what I thought.
Turbo started charging too much.
That's what I thought you said, but then I thought, maybe I heard him wrong, was it Credit Karma?
Credit Karma is into the tax business nowadays. Is that all you want to know? Okay. Okay. So I want to talk about the fix. That's my story tonight. And I think it's a good night for this story because it's about a woman who came to this class. And she knew almost nothing about investing, just almost nothing. Her husband kind of said, come on, you can learn, you can do this. And she's like, oh, I don't know. I really don't care, and I don't think I can. Well, she came, probably drug her there, but she made it. And she stayed, and she learned, and she learned. And she started to dig. She looked at her retirement plan at work. She had what's called a 403B. She works for a nonprofit. And what she came to realize was she was paying a 4.75% load on every contribution she made. And then the expense ratio was coming in at 0.7 as well for the mutual funds. So she was being charged 5.4% per year on her retirement plan. And that shocked her, right? Because she had never asked that question before. She just, started to learn about it when she started to understand this issue. And so she went to the leaders of this organization. She said, can't we do better? And they said, what's wrong? In other words, they didn't even understand what they were doing because they were hurting themselves. Their money was in the plan too. So what happened was she raised enough hell to get Vanguard on the same plan. So now they have two providers, one that charges 5.4% a year, and then Vanguard, which averages about maybe 0.12. And so she's not only helping herself, but she's been able to get other people to invest in these low-cost options that own similar securities just at a much lower cost. She fixed that plan because of her education and her willingness to stand up for what she knew to be right for her and those fellow employees. She fixed it. She fixed this as she fixed her life. And that's a message I'd like to leave you with tonight. Thank you, folks.
I looked at this last week, and these are the only two bonds that are listed, and I've not heard you mention the Lincoln.
Well, yep. So that is great, right? See Vanguard Total Bond? That's all you need.
But they're not putting any money in there. It's
Well, because
all-
you told them not to.
No, I